For most people, borrowing against your 401k is one of the big sins in retirement, right up there with blowing your life savings on a new Ferrari or carrying a lot of credit card debt into retirement. But is never borrowing against your 401k always the right advice? Well, the answer is no. There are specific situations where it might be okay, and not having the option available to you might be leaving an important solution on the table. Let's start with what the internet advice skips past, and that is the standard advice is never touch your 401k. It's your firewall. This is solid advice for many people, but you need to understand the why, because if you understand why, then you'll know if the exception applies to you. First, your 401k sits behind a wall of rules. You can't get at it easily. This is not a design flaw, this is intentional. And this makes it very hard to go into your 401k when you're having a bad Tuesday and book a flight to Europe for a long weekend. Here's the part that usually gets left out, and that is the nature of the credit card debt. Most people assume that if someone has $20,000, $30,000, $40,000 of credit card debt, it happened over a period of time. Bad debt, so to speak. But if it happened at a point in time, like a medical bill or something like that, it's a different type of credit card debt. This matters because the balance on your credit card is a symptom. It's not necessarily the disease. But for a lot of people, if you pay off $40,000 of credit card debt with a 401k loan, that empty credit card or group of credit cards starts to fill up again. And over a period of a few years, now you have two $40,000 balances that you need to pay down, not just one. This is a double loss, and it's the reason that most people say no to taking out a 401k loan. Now, everything we're talking about on this video assumes that you're honest with yourself about this point. Now, if you're going to consider it, you need to understand the mechanics of a 401k loan because there's a lot of nonsense out there about this. Let's start off with the point that's genuinely true, and that is when you carry credit card debt, you're paying interest to someone else. When you have a 401k loan, you're paying interest to yourself. The interest really does land back in your account, and this is one of the strongest reasons for doing this. Now, the rate itself, there's no IRS rate for a loan. Vanguard's How America Saves report says that the rate for 73% of 401k loans out there is prime plus 1%. Still others are prime plus 2%. Prime plus 1% today anyway is 7.75%. When you look at that against the 22 or 24% interest rate that someone's paying on their credit card, you can see how someone might get interested. 7.75% back to them or 22 to 24% to someone else. However, I need to correct something that is all over the internet that's absolutely not true. You don't get to keep the market rate on your investments in your 401k and get the 7.75% in this example anyway. When you take out a loan from your 401k, the fund sells investments to pay for that loan, so they're not continuing to grow. Your account now holds a loan instead of shares, and that loan in this example is paying 7.75%. You get one return, not two. Now, there are certain insurance products that will pay you both. That's probably where the data originally came from, but if you're taking out a 401k loan, the 401k provider sells shares to pay for your loan. Now, on the flip side, one thing that a 401k doesn't have is something called a margin call. Because they're selling shares, there's no longer a risk that that money and the value of those shares can go up or down. If the value went down and you had a loan on those shares, the fund might need more money just to make sure that the loan gets repaid. But since they're selling the shares to pay for the loan, there is no margin call. Now, there are two things to check with your plan. The first is some plans won't allow you to continue to contribute to the plan if there is a loan outstanding. And the more common outcome is that even if you can continue to contribute, the tighter cash flow stops you from doing that anyway. The second is check the employer match, because if you can't contribute or you contribute below the maximum employer match, then you're losing money on the employer match. And that changes that 7.75% return. And the last thing is that the debt does not disappear. You're simply changing the nature of the debt. You now have the payment coming out of your paycheck instead of writing it from your checking account. So what are the actual rules? Well, there are four things that you need to know. The first is how much you can borrow. You can borrow up to $50,000 or 50% of the value of your vested balance in your 401k. Your vested balance is the amount that goes with you tomorrow if you leave the organization. Sometimes an employer will give you a contribution to your 401k, but require you to stay for a period of time before you get that amount. That's unvested. Once you've fulfilled that obligation, that time becomes vested. So it's $50,000 or 50% of your vested balance, whichever is lower. If you have $80,000 vested, you can borrow $40,000. If you have $200,000 vested, you can borrow $50,000. You get the point. One exception on the low end, if you have a balance in your 401k under $10,000, some plans will let you borrow up to the balance in your 401k, but it is determined by the plan, not by the IRS. Now that you know how much you can borrow, you need to know how long you have to repay it. And the answer is, under most circumstances, 5 years, repaid at least quarterly from your paycheck. The third is, does your plan even permit it? 80% of the plans out there do, and that covers 91% of the employees contributing to a 401k. So the chances are pretty good that it does, but you need to check with your plan administrator for confirmation of this. One important point, you cannot borrow from an IRA. It is just a 401k. When you roll your 401k into an IRA, that money is no longer eligible to borrow against. Number 4, and this is a question that I get pretty regularly for people that want to borrow from their 401k. If I'm under 59 and a half, do I have to pay a 10% penalty for sourcing those funds? And the answer is no. If you were to go out and take money out of your 401k and you are under 59 and a half, under most circumstances, you would have to pay a 10% penalty and you would have to pay tax on the money that you take out of your 401k. But this isn't a withdrawal, it's a loan. A loan that follows the rules is not a distribution from your 401k, which means that there's no tax, no penalty, nothing to report. Now, if you stop making payments on the loan and you're under 59 and a half, then the loan will be deemed to be a distribution and you'll have to pay tax on that distribution and the 10% penalty. And by the way, if you leave the company and you can't repay the loan, then the same thing applies. You owe tax on that distribution, and if you're under 59 and a half, there's a penalty. But a loan in good standing, no tax, no penalty. This is what makes a loan different than a hardship withdrawal. Okay, now one question that might come up with a lot of you is, if I borrow $40,000 from my 401k, what will my 401k balance look like in 15 years? Well, the answer is not something that you can generally calculate just on a spreadsheet. Now, on this channel, we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software. That's the personal financial planning software that I personally use. With Bolden, you can model out a lot of different what-if scenarios, and it will show you what possible outcomes will look like 5, 10, 15, 20 years in the future and more. If you'd like to try Bolden free for 2 weeks, you can use our affiliate code. Simply go to go.bolden.com/Schmidt. You can try Bolden free for 2 weeks. After that, it's just $12 per month paid annually if you decide to keep it. All right, now that you understand the rules, let's talk about when it might make sense. And there are 5 situations that we see pretty regularly. The first is high-rate credit card debt that will not come back. The math is real on credit card debt. If you have a $20,000 credit card balance and you're paying 22% interest, that's about $4,400 a year. The same $20,000 balance borrowed from your 401k at 7.75% is $1,550 per year, and that goes back into your 401k. You're actually cutting your interest cost by 14%. But be careful how you describe this to yourself. That is avoiding interest. That 14% differential is you not paying someone else the extra 14%. You're not getting it in your 401k. Those are completely different things, and it's important to know this when you're deciding how much debt to take on in your 401k. And the condition, let's call it the great commandment, because it's that important, is that your credit card balance needs to stay at 0 after you do this. And here's the test that I would use to help you on this one. If you look back at your credit card balance over the last 3 years, did it ever go down and stay down for a period of time? If the answer is no, it's only been one way, then a 401k loan is probably not right for you. If it did go down, then the balance probably came from a defined event that is now over, and it's important to keep listening. Now, the second situation, a real emergency where a hardship withdrawal is your only other option. This is the strongest case on the list, by the way, and it's important to compare this side by side. A hardship withdrawal of $25,000 is permanent. It's taxable as ordinary income, and if you're under 59 and a half, add the 10% penalty on top. Depending on your bracket, you might net $16,000 or $17,000, and the money never goes back into the account. A $25,000 401k loan is $25,000. No tax, no penalty, and the loan slowly gets repaid. The thing that you do miss out on is market movement over the period of time that the loan was outstanding. Same need, same account, two completely different outcomes. If those are your only two choices, then the 401k loan will win almost every time. One more thing to note here, there's no credit check. No one pulls your credit. No one can say no based on your credit. For someone whose credit has taken a hit, this could mean the difference between having an option and having no options at all. The word emergency is important, though, in this decision. A furnace that fails in January is an emergency. A wedding that's happening in the fall is something that you plan for. It's not an emergency. Situation number 3, the down payment on a home you're actually going to live in. This is the one carve-out in the tax law that gives you a bit more headroom. Let me explain. A 401k loan that you take out to buy your principal residence generally has more than 5 years as a repayment period. Sometimes it's 10, sometimes it's 15 years, as an example. The law permits it, but your plan still needs to offer it. Some plans don't, most plans do. Why does this matter? Because let's say you're $30,000 short of 20% down, and you now have to pay private mortgage insurance. This sits in place for years, and it can be very expensive. And there's a second benefit here that most people don't know. Fannie Mae's own selling guide, section B3-6-01, says that repayment of debt secured by your retirement account is not counted as a monthly obligation. In plain English, a 401k does not affect your debt-to-income ratio the way a car loan would affect your debt-to-income ratio. Now, that's the rule on paper, but individual lenders can be stricter, so talk to the mortgage provider before you make any decisions about this point. The next one, you're 59 and a half or older and you're still working. The closer you get to retirement, the more risk you have that you might not be able to repay the loan before you get terminated. Now, this one almost never gets discussed, but for a lot of you watching, this might be the single most important piece of the video. The 10% penalty is what makes a 401k loan genuinely dangerous. But once you're 59 and a half, then if you're laid off and you can't repay the loan, you don't owe that 10%. So run the worst case scenario. You borrow $40,000. 2 years later, you are laid off and you can't repay it. You owe tax on that $40,000, but you don't owe a 10% penalty. And under a change made in the 2017 tax law, a qualified plan loan offset can be rolled over as late as your tax filing deadline, including extensions, which means an offset that happens in, say, 2026 gives you until October 15th of 2027 to come up with the money and roll it into an IRA. The worst case scenario goes from an immediate disaster to a problem that you have more time to manage. Number 5, a short bridge to money you're confident is coming in and it has a date on it. A house closing in 60 days, a bonus coming in March, a deferred compensation payment, a single lump sum pension payment. And here's an example of what this might look like. You need $30,000 today, but you also know in 4 months you're getting a payment that will cover that $30,000. Your alternatives are selling from a taxable account, which means that you might have capital gains, or selling at a bad price, or a personal loan, which might be 12, 13, 14%. A 401k loan for 4 months, repaid in one payment, costs you very little. The money is out of the market briefly, the interest goes to you, and then it's over. The discipline here is the word dated. There's a date certain. If you don't have a date, then this may not be the tool for you. And of course, know the plan's rules before you count on paying it off fast. Some plans have an origination fee. Some plans won't let you reborrow again or won't let you reborrow again for a period of time. Now notice what all 5 of those have in common. Every one of them is a specific problem with a defined end. Not one of them is lifestyle spending. If your reason is not on this list, it probably is not a reason to borrow from your 401k. Now let's talk about the risk that everybody faces, and that's losing your job, but I want to put it in proportion for you. If you leave your job with a balance outstanding, the balance generally comes due. If you can't repay it, then there's generally an offset. Taxable income, and if you're under 59 and a half, 10%. That is a real risk. There's no doubt about it, but look at it clearly. If you had credit card debt outstanding at 22%, you would have to make the payment on that credit card debt. You'd still have to pay it every month, and you'd have no ability to pause it, and you'd be paying 22%. Now, if you lose your job, It's important to know that the 401k didn't create the risk. It just changes the nature of it. Now, there are 2 points that soften this risk, and both of them don't really get reported. The first is that 44% of plans outstanding allow you to continue to make the payment to the plan. So if you're laid off, talk to the plan administrator and find out if you're part of the 44%. If you are, it gives you options that you otherwise would not have. Second, understand your rollover window. Since 2018, it's been more than 60 days. We talked about that earlier. It's April 15th or your tax deadline. For a lot of people, that's often more than a year, not just 60 days. Now, I'm going to help you calibrate here with 2 honest questions. The first is, if your 401k was off the table completely, would you take out a loan to pay for whatever it is you need to pay for? If the answer is yes, then a 401k loan might be a viable option for you. If the answer is no, well then perhaps a 401k loan isn't the way to go. Test 2, and this applies if you're paying off a credit card, have an honest discussion with yourself about how the balance got to the level that it did, not the one you tell people at dinner parties, the truth. You don't need to tell anybody else, but you need to know the truth. Was it a defined event with an end to it, like a job gap, a medical issue, a divorce, the roof? Or was it the slow drip of spending a little bit too much each month? If it's the second, the 401k loan won't fix the problem. It'll hide it for about 18 months, and then you'll have a much bigger problem on your hands. So if you look at this honestly and you think you have a spending problem, then I would not recommend taking out a 401k loan. Get help first. Maybe talk to a credit counselor through the National Foundation of Credit Counseling, which is nonprofit. A 401k is a tool to a problem you've already solved, not a solution for a problem that you haven't solved. If you like this video, check out that video, 5 expenses retirees can cut without even feeling it. Also, don't forget to check out Bolden for your 2 weeks free. Go to go.bolden.com/Schmidt. Try it free for 2 weeks, and if you like it, it's just $12 a month paid annually. This is Geoff Schmidt, and I will see you in that video right there.